He's known for having coined the terms price makers and price takers. Kitco News caught up with U.S. global investors Frank Holmes at the New Orleans Investment Conference.
Well, gold is still in a secular bull market, and it's very important to observe what's taking place versus the 70s and today. In the 70s, China and India, which is 40% of the world's population, had no global footprint, no economic activity. They were socialists fighting with each other. Today, they are significant buyers of gold, and as their GDP per capita rises in China and India, there'll be a slow consumption of gold. It's not going to spike it through the roof, but just as their economic activity grows, then you're going to see this continuous buying. They're called the price takers. And also now we have the price makers, the investors. And it's to understand that when the price makers and takers come together, you get these surges, but then gold can correct. And right now we're in this sort of seasonal buying where people buy gold for their heart. At the same time, people are concerned about quantitative easing. So it's really important investors identify both sets of the demand. I really don't know. I believe that quantitative easing started when the administration went after Wall Street back in April. You can see that the 10-year note, the U.S. government 10-year note started to fall, and it's been falling now since April the 15th. That is a part of quantitative easing. Now all of a sudden they're talking about it, so maybe it's actually over. Well, the two big factors that drive the investment demand based on history are negative interest rates and deficit spending. And anytime a country has negative interest rates, that is, whatever they're paying on the treasury bills is less than the inflationary rate, gold starts to rise in that country's currency. And in the backdrop, if you have continuous deficit spending and you have negative interest rates, then gold starts to rise and stay sustainable in a rising bull market. I believe that the governments around the world are going to fight deflation. And as history has shown, for the next 2 years, it's going to be very evident of this battle against deflation. So you're going to have big deficit spending, and whenever governments fight deflation, they offer negative interest rates. Gold performs exceptionally well. So you have both buyers in there.
If someone's looking to get into the market, is it too late? Are the prices too high now?
What's important for all investors to understand is the DNA of volatility. In gold, over the next 12 months, it'd be just normal for it to go up 15% or fall 15%. That's its annual volatility for the past 10 years over any rolling 12-month period. Gold stocks is 40%. So it's important to recognize that the inherent volatility, if gold was to correct 5%, 10%, etc., then buy the gold. Look for any kind of a correction of that magnitude.
For Kitco News, I'm Daniela Cambone. Stay tuned to Kitco.com for your latest market information.